now over 3 years since I first started warning that there is something seriously going wrong at Tesco, Britain's supermarket giant, and that stock investors should take a note and sell out at what was then a stock price trading near its all-time high of £3.83. At the time I was criticised for basing my views purely on anecdotal evidence. However, as experienced investors know, that to truly understand how a company is performing, one has to experience its service and products firsthand as a consumer. And so in a series of articles starting October 2013 and spanning more than a year, I warned that Tesco was seriously lacking when it came to customer service, in that its demoralised and underpaid staff were going out of their way to put shoppers off from capitalising on their various offers, such as spend £40 and get a £5 off your next £40 shop voucher. In fact, several months before my first Tesco article, I actually wrote to Tesco management warning the supermarket giant looked set to face a crisis as poor real customer experience meant they were going to hemorrhage big spending customers. But all I got back was a bland reply that failed to pick up on any of the points I made that would prove to be harbingers of what was to follow. And so the Tesco share price entered what could best be described as a death spiral, and despite hitting bottom at £1.37 has since underperformed the FTSE, as revelations of just how badly the supermarket giant has been run went from bad to worse, from its debt black hole to outright accounting fraud. So now in this series of videos I will attempt to evaluate if Tesco has finally turned the corner or not.
Tomatoes, got a red pen in Tesco for £6.
In June 2016, the people of Britain voted for freedom, against the illusion of freedom that the establishment political elite had manufactured during the past 40 years, one of playing past the parcel at each general election. A political elite that had systematically been selling British sovereignty to the emerging European Union superstate for personal gain. Whilst the implementation of the mechanisms for leaving the European Union remains pending, i.e. the triggering of Article 50, which should be triggered before the end of March 2017. However, despite little so far having changed on the ground in Britain's relationship with the EU, there was one significant immediate reaction to the vote, which was sterling's sharp drop of 20%, and which currently stands about 70% below its pre-Brexit trading level. The implications of sterling's sharp drop are obviously inflationary, resulting in an increase in the price of imports, and therefore has been exerting upwards pressure on shop prices as suppliers restock at the lower exchange rates. The most recent inflation data for January 2017 has RPI standing at 2.6% and CPI at 1.8%, which is set against the pre-Brexit RPI of 1.4% and CPI of 0.6%, whilst factory gate price inflation currently stands at 3.5%. The inflation graph illustrates that whilst on face value the retailers have been holding back on passing on sterling's fall immediately after Brexit, however the supermarket giants have been playing a dangerous game of deception with their customers, one of literally fake shelf prices that fail to convert at checkout tills. For instance, this week the BBC's Inside Out programme broadcast an investigation into how Tesco customers are being ripped off as self-advertised offers fail to convert at the checkouts due to the promotions having ended days, weeks or even months earlier. For example, a buy one get one free at the checkout can result in customers paying double the expected price in most of Tesco stores, as the BBC investigation showed 30 out of 50 stores investigated were advertising promotions on the shelves that had ended and thus failed to convert at the checkout tills. Another trick played on customers is the game of shrinking contents of products sold, thus achieving a price hike without changing the price on the shelves.
Grapes cast for pan in a bagging for a bagging Tesco. Grapes boom.
However, as retailers are getting caught in the tricks they play, then increasingly it's more likely that there will be sharp price hikes that will feed into the release of each month's inflation data as the sign of the pressure retailers and supermarkets such as Tesco are under, and thus is likely to result in a further loss of market share as the relative gap in prices between Tesco and the discounters further widens.
Walnuts cost £2.60 for a pack in Tesco. Boom!
We have already had a glimpse of what is going on behind the scenes of battles taking place between Tesco and its suppliers, as illustrated by last October's publicly aired conflict between Unilever and Tesco, the so-called Marmite Gate, as Unilever attempted to lift prices across the board by 10% that Tesco was finally apparently able to stave off for a few months or so. This followed on from Tesco being under pressure after a year-long criticism of how the supermarket giant treats its smaller suppliers. However, Marmite Gate was just the opening shot of what is to come this year, given the fundamentals of a 17% drop in sterling that will result in significantly higher shop prices during 2017. That could send average supermarket prices rocketing by as much as 10% this year. That will destabilise the retail sector as large numbers of customers desert the likes of Tesco in the face of huge price hikes in favour of the discount retailers, and not helped by the likes of the BBC's investigation into Tesco's fake shelf prices, whilst expect many remaining customers to cut back on branded products for cheaper, less profitable alternatives. Therefore, consumers so far are mostly experiencing the calm before the Brexit inflation storm that will increasingly make itself manifest in their weekly shops, that will impact hard on the likes of Tesco and other major supermarkets, acting to derail Tesco's recovery plans after a series of disasters during the past few years, as covered in this Tesco crisis series of videos, with early signs of just how bad things could really get being the recent rationing of vegetables such as broccoli and iceberg lettuces as the supermarkets cut back on perishable stock.
Limes cost 30p each in Tesco. Boom! Lime.
Another thing to consider is the impact of loss of customer purchasing power, as for instance, huge proposed council tax and energy price hikes of more than 10% start to bite, such as Npower's recent 14% price hike announcement. So the supermarkets look set to be hit by a triple whammy of producer price hikes, contracting customer disposable earnings, and loss of customers to the discounters, a perfect storm that will hit corporate results hard during the year and likely trigger a panic response amongst the supermarket giants. As when companies find themselves in trouble in terms of losing revenue and market share, then they tend to double down. So when faced with the prospects of further contraction in revenues, then the name of the game is to artificially boost revenues and market share through acquisitions via debt-fueled purchases to give the illusion of revenue and market share stability. And Tesco has already seen its revenues fall hard by £10 billion, down from £64 billion 4 years ago to £54 billion for 2016. So it's no wonder that Tesco is showing signs of panic, as illustrated by its recent purchase of Booker, owners of Budgens, for £3.7 billion, despite the fact that Tesco already has a huge debt mountain of over £15 billion before this £3.7 billion purchase. So I expect the Brexit inflation tsunami to continue to hit Tesco's and the other supermarket giants hard during the year, which, unless there is another accounting scandal brewing, should become apparent in their trading results and thus a negative factor in terms of stock price performance. And ensure you are subscribed for new videos in this Tesco crisis series as I try to determine just how bad things could get for Britain's supermarket giant and the rest of the retail sector as they look set to face a perfect storm during 2017.